All right, thank you for joining us this morning. I think we should go ahead and get started so we can finish within the 45 minutes. So today I'm just going to be sharing with you just kind of what we're seeing in terms of the short-term market, as well as looking at a little bit about the medium term and long term of what our beef cattle market looks like right now. Okay, so obviously it's an extremely difficult time for us in the U.S. Meat industry right now. The situation, it may be difficult for packers. However, they're generally well capitalized and can handle being down for a period of time. Additionally, when we think about the U.S. meat industry, there's the retail side of things, and they can handle being shorted some product either by raising prices or rationing out that demand, as well as mixing and matching products that are available. But for those that are, it's the most difficult in this U.S. beef industry right now, and specifically the meat industry, it's those producers. So really, the producers are going to have the most difficult time. Producers, we can't tell our cattle, hogs, or chickens to stop growing for a while until these plants open back up. So obviously, there's going to be a flow of animals that move through the farm. And if you stop what's going out the back door and there's still animals flowing through the front door, the entire system is really going to break down for us. So while can be a difficult time for packers and retailers, it's really difficult for us on the producer side. So with any natural disaster, there's probably going to need some support and assistance to assure the survival of many in the beef cattle industry right now, and specifically the producer side of things. So whenever we're looking at of the cattle industry, the economy right now, I think whenever we start talking about uncharted territory, it doesn't even put into context how record-breaking these initial claims for unemployment are. So I mean, there's several 100% higher than any other time period over the last 50 years here. So I think our first assessment obviously is whenever you start seeing these numbers, it's not going to be a good year for us. And then this is just the beginning. This is the first wave of unemployment claims. If we say this is going to be a recessionary year, recessions don't just last a month. So there will be breakdowns throughout the system of businesses that won't be able to sustain their demand and won't be able to make those payments as we move through 2020. So two realizations that we have are the U.S. economy obviously is likely in a recession due to COVID-19 panic, as well as the cattle markets are likely in a significant bear market for the foreseeable future. The global economy is obviously likely in a recession. New numbers coming from the IMF show that these recessions are real, and we should expect them to be confirmed in the third quarter of 2020. So with these two realizations, we have to move forward to better plan our business to make that plan for 2020 and beyond. And then just wanted to throw this in here. This is just looking at the assets that the Federal Reserve has already purchased. So you see when the Federal Reserve really started purchasing assets back there in 2008, 2009, and it's in 2009 they had about $2 trillion worth of assets. Over the last 10 years, they really haven't been able to liquidate much in terms of the assets that they're holding, that they're purchasing from U.S. corporations, as well as some debt around the world. But obviously, you can see over the last month, those assets had significantly risen up to $6 trillion. This is obviously the highest total amount of assets that the Federal Reserve has ever had. So a little bit part of this stimulus package is the Federal Reserve purchasing a lot of these assets, potentially some stocks as well as some treasuries here to help boost that economy. So a part of this, the economic impact of this recession that's potentially occurring, there's already been that easing taking place, and you can see that in terms of some stock prices recently. Whenever we think about volatility, so obviously this is on CNBC from last week. Last Friday was the Dow's best week since 1938, and over the past 3 weeks, more than 16 million Americans have lost their jobs and filed for initial unemployment claims. So obviously those two really don't go together, but that shows you how much volatility there is in the market right now. So where are we? In terms of prices, obviously uncharted territory. I mean, in terms of price changes, we're talking about 2015, 2016. In terms of the significant downside that we've seen in beef cattle market prices, obviously we're seeing huge changes in terms of how we consume beef, from changes from a lot of these cuts that were potentially made for the restaurants really having to be merchandised through the retail side of things, not just here in the United States, but globally as well. We're seeing major disruptions on the supply chain. Specific disruptions that we're extremely concerned about is some of these packing plant closes on the beef side of things can be very, very detrimental to what we're doing here in terms of being producers. And then I think, whenever you're thinking about the future of the beef cattle industry, obviously there's probably going to be some reactions from consumers as well as government agencies that they're going to affect the future way that we produce beef here in the United States. So those the types of things have to be on our mind, as well as what potential regulations may be in effect for the future for us. So whenever I look at what things I thought were going to impact us in 2020, made this in middle of January. Coronavirus, there was potential there. We had that on our list. We didn't have meat plants closing. That was the one thing on our list that we really did not, we weren't able to visualize those meat plants closing in 2020, and that's going to have ultimately the most detrimental impact on us here. African swine fever, a lot of people have forgot about it, still impacting China. There's still more spreading going on if you look at the news for African swine fever over the last couple of weeks. So COVID-19, they may have gotten around that in China, but African swine fever is still spreading. There's still that potential for trade wars, the uncertainty behind the trade agreements that we've made, as well as some trade agreements that have been really successful for us. So the border really hasn't been a big topic for us lately. We've moved into these other categories. Risk of recession is here. We knew that recession was on the horizon just based on the variables that we study for recessions, as well as thinking about the length of the business cycle being the longest ever, over 10 years, getting back into some time periods where things might not be as good for the U.S. economy here. Interest rates, inflation, that's still a concern out there. Maybe we don't see it typically during the recession, but it could come into play coming out of this recession. Balance sheet write-offs, obviously no longer a concern. If you saw back there on that chart, in 2018, 2019, we had balance sheet write-offs from the Federal Reserve. Not an issue right now. Cost of production, I think, is going to be a huge factor for us in 2020. Revenues decline, costs were still pretty much at the same level. There's been some reductions typically in terms of the fuel costs, but there could be some higher prices in terms of some protein feedstuffs for us. Ultimately, whenever I'm thinking about tight margins, 2019 through 2021, these were supposed to be our tight margin years for us. This was the bottom of the beef cattle price cycle that we projected back in 2015. So those margins were tighter than normal, and then we had this COVID-19 move into this U.S. marketplace and significantly got tighter into a time period where there was going to be negative margins. Now there's going to be significantly negative margins on average for us in 2020. Potentially out there, there's some weather-related impacts that we got to continue to monitor, be prepared for in 2020. So I'll share with this. This is something that Joe Outlaw said at a economics conference in 2018. I still think it applies greatly to us today. He said, "I'm not going to say that all farmers are broke and we're headed for a 1980s type crash, but what I think is true for the 300,000 to 400,000 real farmers in the United States, the likelihood of failure is equal to the likelihood of staying in business. Some just don't realize it, and that's probably more true today than ever before. Across the country, there's record yields that have been experienced in terms of a lot of these crop producers, and these last few years, it temporarily changed the outlook, put off that disaster for now. But now we're going to be faced with this recession, as well as some significantly lower prices than what we were facing the last 2 years, both on crops as well as most crops, as well as on cattle. As we started this year off, we were at a point where there was a lot of U.S. farm bankruptcies taking place, an 8-year high, and we expect that 2020 number to be significant. So whenever we put things in context here, we were already expecting a pretty rough year for U.S. farmers, and now we're adding to those difficulties as well. So kind of the theme of our program, Beef Cattle and Forage Economics program for 2020 was don't fall off the mountain. Make sure that that we have cash flow, we evaluate our balance sheet as well as our assets, and really be focusing on developing our short-term plan, even if it's a one-pager, and then developing in that medium and long-term plan for our cattle operations. It's going to be very critical here as things are significantly tight, and we can lose a lot of cattle farms over the next 2 years. It's going to be very difficult if they don't have those cash reserves. Whenever we're looking at U.S. annual feeder steers here, whenever we're just comparing it over the last decade, as you can see there, 2019 annual average was 143. That's very similar to the cattle prices over the last decade, not including that 2014 and 2015 really outlier years where there were significant reductions in the amount of meat proteins that were available that caused those spikes. So really, pretty level, pretty straight. We're probably going to be closer to this 2020 average back to those, 2011, 2010 levels, and it's very difficult to operate in a marketplace where you're receiving a lower price today than where you did 10 years ago, but costs really haven't started elevating. But again, we expect this to be our bottom of the U.S. cattle price cycle, and we expect hopefully to see these increases moving forward in this cattle cycle. So over the last month, I've been working on an analysis to share with the USDA to potentially assess the impacts that have occurred to U.S. cattle producers. And this is if we look at cash prices from January 10th to April the 2nd. And these are for 800-pound feeder steers. So this is a little heavier animal than what we typically market in the Southeast, but this is what drives feeder cattle in the U.S. cattle industry. From January 10th to April 2nd, the cash market prices lost about $25 a hundredweight, so just over $200 a head, and that amounts to about $12,000 per truckload there. So it's very significant the impact that COVID-19 has had on U.S. cattle producers, and we just wanted to put this into numbers so so politicians can help understand whenever they're sending out stimulus money, can help them understand the impact that's been made from COVID-19 on U.S. cattle producers. Whenever we look at that in terms of feeder cattle futures prices, so what we did here is we averaged our entire 2020 year of prices that are projected out there in the future, and we looked at the average settlement price for 2020, and what we saw is potentially for the whole marketing year, there's potentially large damages out there from from this January 10th starting date, that first day that we started to see damages to those export markets is what we included that as our starting date. And we saw about $37 a hundredweight decline in these average CME feeder cattle future settlement prices. So just under $300 a head and almost $18,000 a truckload here. So obviously you can see in these two charts extreme volatility in the marketplace, and we would expect that to continue as we move forward until more of these unknowns become known. Another thing you'll see here is especially in that last chart as well. Typically in this feeder cattle futures, we see about $20 a hundredweight move. And just between these 2 points, we see 37. If we go from the highest point on maybe the August futures contract is 156, and to this 114, obviously there's over $40 per hundredweight there in terms of price movement. So significant volatility. This is not like the past 10 years, where most years there's only about $20 of per hundredweight of price change there. So really shows the detrimental effect that this volatility has had. Volatility is either up or down. Okay, so getting into some cash prices, looking at Southern Plains here, we've got to use the Southern Plains. There's not enough cattle really flowing through these individual markets to really be able to say much. So using these Southern Plains numbers, OKC, we're able to see where these prices have moved over the first half, or really the first quarter of 2020. Obviously, there's the downward pressure that we saw in the feeder cattle price index, as well as feeder cattle futures. Typically, in Florida, we're about $25 a hundredweight lower than this price right now in that North Florida area, as well as the South Florida area, about $25 a hundredweight. And so right there, about 170 right now on these 400 to 500 pound feeder steers, number one. Feeder steers there. Whenever we look at some heavier weight animals, again, getting these prices, Southern Plains for 700 to 800 pound feeder steers, I think 120 is above 120 lately is still really not a really bad place to be in that local cash market for the Southern Plains. Again, probably $15 to $20 a hundredweight behind these prices if we're looking at them for Florida. But again, these are actively traded cash prices for 700 to 800 pound feeder steers in the Southern Plains. But overall here, you see, almost $30 per hundredweight of movement throughout 2020. I think you'll see that, we're nowhere near the 5-year average, but we're not near 2019 prices anymore. We're significantly below them. Some slaughter cow prices, just, this is 15 to 25% of our revenue for the year. So it can make up a large portion of our revenue. Slaughter cow prices over the last couple of weeks, as you start seeing some of these beef cow plants, close or have disruptions in terms of less inventory that they're able to slaughter, less animals moving through the plant. There's going to be some declines out there, even during this time period. That's typically our highest of the year. So we've probably seen the peak here in the first quarter of 2020 for these slaughter cow prices. And when you're comparing it back to 2019, there's precedence here of them being below $35 a hundredweight here in that late October, early November timeframe, where there were some significantly low prices there. Again, extreme volatility on these slaughter steers due to COVID-19. To date, over $20 a hundredweight price change. Looking at this 5 market weighted average price of these slaughter steers, so talking about good 1,250 to 1,400 pound steers in some instances here. Significant declines on the cash side of these slaughter steer prices, and these are live prices, obviously. Whenever we start thinking about exports, I'll just throw in here, our beef byproducts as well as hides, significantly lower. Whenever you see this trending lower, typically that means our export markets, those consumers, their economies, as well as their potential cash flows are not as strong, as well as their opportunities to eat these byproducts at restaurants over there in some of these Asian countries. So obviously that's going to impact that price that we can pay for live cattle as well as feeder cattle and feeder calves throughout the U.S. So it's very detrimental that this price is as low as it is at any point over the last year to the previous 6 years now. This is the lowest point that we have currently based on these beef byproducts and hide. A lot's been said about box beef cutout values from that point where obviously U.S. consumers really rushed the retail stores and started buying up a lot of beef products. The meat case was empty for a long period of time here. By long period, just meaning certain weeks here. But obviously that's come back down as there's still long-term uncertainty as did consumers, did they buy, how long are they able to survive off of what they've already purchased, and will there be time periods where they don't come to the grocery store, as obviously we're dealing with a very delicate product that doesn't have a significantly long lifespan on these fresh products. So that's just something for us to take into account and really evaluate here on this box beef side of things. And that's kind of why we've seen the uncertainty in prices over the last 2 weeks here. So, originally when we picked out this topic back in October, we were focusing on the beef cattle price cycle. And kind of what we've been doing since 2015 is looking at this cycle and evaluating when we thought there was going to be a low in terms of beef cattle prices based on changes in supply, and really supply driving this thing in terms of the beef cattle inventory and beef production. So what we did was we analyzed these phases of the cattle price cycle based on previous cattle cycles. And so we developed these 4 phases of the cattle price cycle, use them to help cattle producers understand when profits and losses would exist in the cattle industry. And we did this based off of the last 8 U.S. cattle inventory cycles. Obviously, these cycles help us understand the potential length as well as what changes in terms of beef cattle prices typically happen during each phase of the cycle. So based on these past cycles, we're able to see, when these increases of beef production are going to cause that transition to cyclically lower cattle prices. And as long as that herd expansion continues, beef cattle prices are likely going to approach most producers' cost of production. And, as we saw beef cattle expansion stop for this January 1st, 2020 number, now we've got that expansion to the point where it has approached most producers' cost of production. When I say cost of production, I mean fixed costs as well as variable costs. So we're including everything, not just the potential things that we may use for other operations. We allocate those to our beef cattle operation as well to figure out what that total cost of production is. So we've got our 4 phases. This is kind of what we how we thought it was going to play out just based on these past cycles. Again, these cycles are reoccurring for the last 150 years. Top of the cattle price cycle, obviously we can call that 2013 to 2015. We've been in this downward price transition 2015 to 2019. Bottom of the cattle price cycle 2019 to 2021. It's kind of what we expected. Even without the COVID-19 bottom of the cattle price cycle, we expected there typically to be a recession during this time frame as well. And additionally, these are based on our FAPRI numbers, so our Food and Agricultural Research and Policy Institute, that's from the University of Missouri for our domestic prices. And then we found that phase that the upward price transition was going to occur from 2021 to 2027. So that's kind of how we saw things playing out. Obviously, there were significant profits in that top of the cattle price cycle, declining profitability each year as we move through the downward price transition. Bottom of the cattle price cycle, on average, most producers will face significant losses. I hope that their balance sheet as well as their cash reserves are in order to survive this, so we can move back into that upward price transition where we've got profits and losses, but overall we have improving profitability from somewhere in 2021, 2022 throughout the next decade to 2030, obviously. So that's kind of putting it out there in terms of these four phases. But whenever we think about what really happened, 2015, 2016, significant dives in terms of these cattle prices. So what did we see from July 2015 to that October 2016? Significant decline in prices. We moved in terms of seasonals. Even though we had increases in terms of beef production, demand really played an important role in keeping prices where they were on average pretty steady over the last 3 years there for 17, 18, and 19. 2020, we're looking at our low here. Hopefully we get that low in 2020 and we can move forward from 2021. But those projections out there that we've been using from FAPRI, they see those increases each year moving forward, and that's what we've got to be focused on and we've got to be excited about after surviving 2020 and these market prices. That's going to be key for us. Survive and then thrive is our new focus for us. So if we look at it in terms of a 5-year transitions here from 2010 up to that 2015 high, that was about a 5-year period where we saw those increases. We've been in this downward price transition for about 5 years, 2 really, really large declines, and then again here in 2020 beginning another large decline, and then moving forward from 2020, 2021 up there to this next high, potentially out there even past 2025, just given the circumstances we have today. So I'll show you those projections. These are based off of 500 different models that were run in September 2019. We don't have new projections yet. Hopefully they'll be coming out here soon from FAPRI. So this is where our expectations were 2019 to 2020. Not much change in the U.S. cattle and calves, but then from 2020 moving forward, declines in our U.S. cattle and calf inventory in the United States. So, if we think about where supply is, the fundamentals of supply, we're supportive of prices moving forward now. So as this supply declines, obviously that's going to be very supportive. There won't be as many cattle and potentially as much beef production moving forward. So looking there at beef production, you do see beef production continuing to be record large, so it really puts an emphasis on those export markets as well as our domestic market to still be able to consume, even because there's a lag here. Just because cattle and calves are declining, there's going to be a little lag. So we see from 2019 to 2020, there's still being that significant step up. We're still having those cattle from 2019 being slaughtered in first quarter 2020. And we'll see the same thing for 2021. There being that lag, and then we move into this declining market. And then whenever you think about U.S. meat protein production, everything's up in the air now. Obviously poultry and pork can slow down their production significantly, but here was our projections, is that each year really getting larger in terms of U.S. meat protein production overall. Looking at the specific industries there on the pork side of things as well as the poultry, they were looking at getting bigger over the next 5 years, where beef production was looking to stabilize or getting slightly smaller. So our thoughts in early 2020 is, can exports save the day? In terms of all this meat that's got to be consumed around the world, how can U.S. beef exports save the day? Really continuing to get in those markets in some of those Asian countries, specifically South Korea, Japan, Taiwan, Hong Kong, and some of those smaller Asian areas as well. Getting our beef exports into those countries has never been more important than today. So we really need these U.S. beef exports to continue, especially as our domestic market potentially deals with a recession in the short term. So as we began projecting prices for 2020, our projections looked at about $9 a hundredweight lower. It's kind of where we thought things were. I know there was a lot of expectations for higher prices in 2020. Just using our factory data that we really like and have seen it as very beneficial in terms of projections, they projected us being lower, and this is what we've been utilizing since in our program since September 2019. So potentially lower prices for our feeder calves, as well as these 600 to 650 pound Oklahoma City feeder steers. So this would apply to all of our Southeast cattle as well. And then when we start getting out there into longer projections, you see that 2020 low there, but you see that rising price coming out of this low, and we're still projecting a rising price there in terms of these cattle. As supply has been limited, that potential price, we expect it still to move forward and move a little bit higher through from 2021 through 2028 here. If we're looking at fed steers, again, we projected lows, and the low occurring in 2020 to 2021, they were 114, so about $3 a hundredweight lower on fed steers. And then again, moving higher in terms of price. Box beef cutout really stabilizing that price in 2019, 2020, and then moving higher as we have that limited supply moving forward, or that really a slightly smaller supply moving forward from 2021 to 2024 in these projections. So I want to just hit on costs of production just a little bit for us this morning. And the cost of doing business, whenever we include all the costs, is significantly high in either cow-calf stock or on finishing animals here in 2020. It just shows us the trend over the last 30 years whenever we're thinking about the average cow-calf cost in the United States. I'm not saying these are your specific costs, but these are some of our best projections from LMIC. Obviously, the cost has increased, and it will continue to increase as inputs continue to grow scarce, and we got to evaluate and continue to evaluate and make sure we're using our inputs as efficiently and scrutinizing some of those wastes as best as we possibly can. So focusing on these costs is really going to be critical for us moving forward here. So just a couple thoughts in terms of just our general operation. The market makes the rules in terms of revenue. So really getting focused on projecting our feeder calf revenue each year, determining how much we have to work with can really help us evaluate where we're going to go long term and what practices that we need to put in place. So what I like to do is understand that this market makes the rules for us. This is what we have. Let's allocate it out. We know what our revenue is by making those projections at the beginning of each year. Think about those fixed costs that regardless are going to occur. Maybe they're tractor payments, maybe they're fencing expenses that we've made that we prorated them over 15 years, and then start evaluating those additional variable costs. I'm not saying every year that we're going to be focused on those positive net returns unless we put into place larger margins in this U.S. beef cattle industry. These shocks are going to send net returns negative for the majority of beef cattle operations. So we have to in the future, our focus has to be on developing larger margins to better absorb these shocks that we have in the U.S. cattle industry. Another way to think about this profit equation and really, the market making those rules there in terms of revenue. Revenue is what you get, costs are what you're going to be putting in, and profit's going to be what you keep. So focusing on this profit equation and really drilling down to those key areas for us on revenue, cost, and then allowing it to see, you know, what that profit is out there. And apologize, there is a negative signal there right before profits. That's supposed to be equal then sign. So getting back to thinking, you know, what can we actively be doing right now? And I think I said this at the beginning of our webinar. You know, there's so much uncertainty in 2020. Months to sell is kind of, you know, having a focus in terms of particular month to sell. It's kind of, that's not really an option in terms of we're not able to see when our seasonals aren't going to be in play. Really, right now we're backing up in terms of the feeder cattle that are outside of feedlots. So that's just something for us to consider and get focused on. But ultimately, searching for ways to lower our unit cost of production. We want to scrutinize any you know, the efficient use of our inputs, reduce waste in any typical kind of way that we can. Scrutinize capital purchases here in 2020. We want to make sure that, you know, we have that cash flow, as well as evaluating the debt payments that we have. We want to make sure we can survive 2020, so we can receive those higher prices as we move forward into 2021 through 2028. Identifying these opportunities to enhance cattle market prices. You know, this is kind of focusing on some of those animal science characteristics here. How can we improve the quality of our cattle? Getting focused on improving the quality in terms of where we're marketing, what those buyers are really looking for, as well as the quantity in terms of selling in truckload units. Identifying those economical weights to really match up with what you have to sell. Again, price protection was an opportunity for us at multiple times during 2019 and 2020 to market 2020 animals. We talk about feeder cattle futures beginning 2020 up there at 150, and now we're you know, on an average price we're below 120. So there was $30 a hundredweight easily there that we could use for price protection. But again, most analysts did project higher prices, so I understand why the majority of producers did not lock in that price protection. But it's going to take these things to achieve higher levels of revenue and potentially some low levels of profits during this bottom of the cattle price cycle. So those are some things that what we can actively be doing. You know, as I go around the Southeast meeting with cow-calf producers, what are they really focused on? And the first item there, let her rip. What I mean by that is, you know, a lot of people in the cattle industry, they're having fun. They enjoy their operation. They have a blast with it. You know, they're looking for those things that they find enjoyment in the cow-calf industry. Even on our larger operations, they're focused on the things that they enjoy and have fun with, and there's nothing wrong with that. But I feel like from an economist perspective, we also have to focus on those things that aren't fun and do some of those more difficult jobs to really significantly reduce some of those poor performing categories. A lot of people keeping heifers. You know, they're focused on the long-term genetics of their herd, which might not always correlate with, you know, economics and the prices in terms of generating long-term profits for our business. So it's important for producers to be able to pencil that out. We're giving a lot of cows another chance, right or wrong. It's very difficult to want to market a $300 cow when a replacement heifer is significantly higher than that. So that's just one of the things that we're seeing producers are focused on. They're putting more weight on steers. So that's one of the things that we're currently seeing right now for most Southeast cattle producers. So, you know, kind of what am I thinking about producers really need to be focused on for 2020? I think the first thing, and we began the presentation is there was record number of bankruptcies. There's higher number of suicides in the U.S. farmers. Our focus has to be on surviving 2020, 2021, getting out of this, and then really focus on thriving in those years ahead. You know, what do? obviously we have to continue to do the things that got us here in the first place. We have to focus on our high level of management, and then, work on a week to week basis in terms of marketing these animals, and make the best decision that you can for your operation, because there's so much uncertainty out there. We don't know where prices are going to be next week. So the other thing out there in terms of continuing to wage a war on forage and feeding costs, focusing on those management resources that really account for the majority of our costs, which are typically forage and feeding costs. And then potentially preparing for the next drought. Coming out of winter, I know that can be very difficult, but these are just things long-term on a horizon that we got to have excess residue, excess forage, and potentially a 15-day window of feeding some hay in the spring, or maybe it's in the late summer like it was in 2016, where we're prepared to handle that dry spell or handle that period without depleting all of our forage resources there. So getting prepared for that drought can be very, very beneficial for us. Whenever I'm thinking about a little bit of a summary, so we've got volatile changes occurring in the U.S. and foreign economies. Obviously, big potential in terms of price swings, $40 a hundredweight in some instances here. We've got lower U.S. cattle prices for feeder calves and feeder cattle and fed cattle expected during 2020. We expected that to be due to increases in beef production and those competing meat proteins. We expected that before COVID-19. So obviously, we've seen even further erosion in terms of our revenues because of it. So that's kind of what our summary is here for moving forward from this. Is we've got to be focused on getting these animals marketed, focusing on our balance sheet, and really what these cash flows are for 2020 and just surviving this marketplace. So I appreciate your attention. I'll try to answer any questions that you might have if you'll put those in the question box below. And even given our detrimental prices that we're receiving today, I do hope you have a profitable 2020 and wish you the best of luck for your operation. I would like to just close the presentation by saying that our next ONA Highlight webinar is going to be our May ONA Highlight. That's going to feature our guest presenters from IFAS Extension, Lauren Butler from Okeechobee County, and Lindsay Wiggins from Hendry County. They're going to provide us an overview of the South Florida Beef at Forage Extension Program, and also provide some information on utilizing IFAS Extension resources during COVID-19. So with that, we'll go to our questions and see if we have any. And Andrea, my question box is blank because mine only shows the ones between me and you.
Okay, how odd. Can you hear me all right?
Yes, ma'am.
Okay, so you have a question from Kurt Pepperbrink. So if cattle producers are going to suffer significant losses moving forward, should they consider weaning and selling their calves early? In other words, take the lumps now instead of later?
Thank you, Andrea, and thank you, Kurt, for sharing that question with us. And I think that is a viable scenario for many producers. If you look at early weaning, providing some additional weight gain for those cows prior to the next breeding season, I think that's one thing that producers should consider and look at if that's a potential opportunity for them. I think that's an excellent way for them to think about marketing their cattle. Is we don't know how bad things will get here in terms of this beef cattle market, how long this will last, and there's potential out there for that to be a very viable management strategy for some producers. So it's paid dividends in the past, as well as right now we're dealing with some significant drought-like conditions. If we don't have that additional forage and feedstuffs that obviously if we can't get some additional feed in those lightweight calves, that may be a time period where we do take our hit here, save that long-term viability of those herd, getting them repregnant, maybe if we haven't already got those animals rebred. I think that's an excellent management strategy for producers to consider. So thank you.
Is there any other questions? That was the only question listed. We'll give you just a moment if somebody does have another question to type it in. Otherwise, if not, you're welcome to contact Chris anytime. We have another question. Okay, we have a question from Cole. He's saying, how is the failing dairy industry playing a part in these price changes?
Absolutely. Thank you, Cole. So one of the ways that the dairy industry is playing a part in these price changes is there's a significant number of slaughtered dairy cows that are moving into into our slaughter cow market. As those slaughter cows obviously are replacing some of the beef cows that could be in that pipeline and really reducing some of the slaughter cow prices that we're seeing here in 2020 and really moving forward. There's going to be some additional dairies that have to close. So it's survival of the fittest in the dairy industry, as it's been for the last 5 years, a very significant time for them. So moving those dairy cows into our slaughter beef pipeline has really significantly helped those packers reduce the price that they're having to pay for slaughter beef cows. So it's really hurting us on the slaughter beef side.
Next question is from Dennis. He says, what causes the fluctuation of meat supply at the stores?
Absolutely. So Dennis, one of these causes, obviously one of these causes has been unprecedented demand. It's not an increase in demand. It's just, they just move their purchases forward. Demand hasn't increased in terms of individuals want to put more beef, at their dinner table. That hasn't changed. They've just changed when they purchase that beef. So as well as, maybe there's been changes in the purchasing of different cuts, but overall, we look at those spikes there in terms of those box beef prices. One highlight there is that didn't when those prices started rising in the grocery stores, that wasn't going back to the packer, where while they already had significantly large margins, those first couple price increases were from the retailer, not the packer, and that was to ration the supply of the product. Overall, significant changes in the beef that's occurring in this beef pipeline, and there's a lot of volatility out there, and the reason for that is because they don't know how much purchasing is going to take place in the next 30 days, in the next 60 days. Just a lot of unknowns out there, and whenever you're dealing with a fresh product, to receive those higher prices, consumers want the fresh product, not the frozen product. So in order to receive those higher prices, there's so much uncertainty in terms of getting that meat at the counter at a fresh, that they don't want to take too much risk on their end of things right now, given this uncertainty. So that's really hurting us getting these animals slaughtered, as well as the closing plants are very, very detrimental to our producers, given our first two slides of animals moving in the front of the building but not going out the back. So definitely some overcrowding out there in our feeder cattle situation, as well as some feedlots.
The next question is from Paul. He asks, do the economics favor holding over open cows versus replacing them with bred ones?
Okay, so does the economics hold favor holding open cows versus replacing them with bred ones? I would say that the economics, if that open cow could have a 5-year useful life, the economics obviously favors her, as well as on bred cows, replacing those open cows with bred cows. Both of those economic scenarios work given our current prices looking over the next 5-year period. Which one would potentially work if I knew the useful life of that animal? If our bred cow's got a longer useful life, replacing an open cow with a bred cow, if they have similar useful lives, just given what this open cow potentially is, then the open cow is going to make just as much economic sense as a bred cow in this scenario. Both of them, though, if $1,000 replacement heifers, bred cows, open cows in that same price range, if they've got a 5 to 7 year useful life going forward, extreme economic sense. There's profit opportunities out there as we've looked at those projections and looked at how this price cycle is really going to function moving forward. Both of those cows have opportunity for profit. So I like both of them.
Okay, our next question is from Ethan. He asks, how do you think this will impact the local demand and marketability of the local freezer beef programs?
Thank you, Ethan. The first way is, local programs are probably sold out of their product. And I think that there is going to be some shift from consumers they're looking for, developing relationships with farmer on the local level. In local, typically USDA's definition of local level is within 450 miles, but local level meaning probably within 150 miles. Those consumers are probably going to get focused in. Those consumers they're desiring that specific product they're going to get focused in on what those producers are consuming are producing, and having a desire to have that deep freezer space. There's going to be some of those consumers out there. I think on the other hand, though, we may lose some of these high-end customers where we're not able to charge those premiums. That's one of those concerns that I have out there, is that how deep this recession goes, we might lose some of those high-end customers. So I think there's going to be more demand from some, but overall demand, it might be about the same as what it was until those consumers have more dollars that they are able to spend on those specific products. But I really, that's been one of the focuses currently right now is, if we had a local supply chain, we'd be much better off, in terms of being able to market some of these products. If we had regional packers or even our local producers that might send them through an individual slaughter facility. So there's positives out there. We just have to work through them and deal with our business the best that we can during this uncertain scenario.
Okay, Dane has a two-part question. First part, when would you predict a buyer's market for replacement heifers? And just so you know, his second part, and conversely, when would there be a seller's market for replacement heifers?
Okay, seller's market for replacement heifers at the next peak. So seller's market I'm answering the first question first. That's the easiest one, I think, is the seller's market for replacement heifers was 2014, 2015, parts of 2016. That was our seller's market for replacement heifers. It'll be the same next time. We'll look at out there, 2026, 27, 28. There've been a really good seller's market out there. It's a long ways away. No one likes to think out there 8 years from now is when that selling opportunity is. But I think that's the highest potential revenues out there are probably going to occur during that time frame, just given our projections that we run. The buyers, fall 2020, 2021, whenever we feel like we've got a bottom of the cattle price cycle, replacement heifer prices will definitely be depressed, and that's when you know, if you use Warren Buffett's scenario of buy low, sell high, which makes plenty of sense, that's when you gobble up all the you know, the cheap assets as possible, as long as they've got long-term breeding value, and we potentially could see some $1,000 to $1,200 replacement heifers this fall. I think that there's a lot of potential if we're developing them to save those back into our herd if we can find additional feed resources and grazing lands. That's definitely got to be a thought process for us moving forward. That's kind of where we're pushing our clientele, and all this is based off of these long-term projections from FAPRI. We have to have a, you know, a 10-year plan as we start playing with the replacement heifer cycle, start thinking about when we're going to be adding and culling replacement heifers. We have a plan for the future based on where prices are. And so based on those FAPRI projections, that's how we're determining replacement heifers or open animals or bringing in additional bred cows.
Okay, that looks like that'll do it for our questions. And I just wanted to let all of you guys that are still with us, when this completes, you should receive an email with a survey. If you can spare a couple of minutes to give us some feedback, that would be awesome. And now I'll pass it back to Chris for some final remarks.
Awesome. So just wanted to thank you for your time. I know this is a very difficult time for us in the beef cattle industry. We're going to continue to work through this the best that we can. And you know, again, from an extension standpoint, working with producers, providing them with as much information on the economic side, as well as our animal science, agronomy, and soil science side, that really affects the outcomes for each producer as much as possible right now is kind of what we're focused on from the extension side. So if we can be of any help, please contact us, and you know, we'll continue to guide you as we move through this volatile time period. With that, we'll sign off, and we hope you have a great rest of your day. Thank you.